Good morning, students. Murthy Academy welcomes today the discussion on fundamentals of the balance sheet. In the finance management, the understanding of the balance sheet plays a very important role. And you are all aware, as a student of the finance or a person who is having interest in the business world, that balance sheet is a word which every one of you know. What is this balance sheet means? Balance between the liabilities and assets. Liabilities means what we have to pay, and assets means what we can realize. The difference between the liabilities and assets in a given situation is called the profit and loss. Supposing in a business, my total payout is 100 rupees and my assets position is about 200 rupees. That means I have to pay 100. How to get 200 means the difference is positive. That is called the profit 100 rupees. Similarly, if the payouts are more, if the liabilities are more, payables are more, and realizations are less, then it is a loss. And these liabilities and assets normally again have a lot of scientific treatment in the balance sheet. And it has a these liabilities again are classified into three parts mainly. The first part is what you call this capital. Second part is called short term borrowings, and the third part is called the long term borrowings. See what is happening. The liabilities are also known otherwise sources. Why they are sources? Supposing I want to start a business. The total business requirement to start a business is okay, some manufacturing activity is there. I have to take an office or admin, and I have to hire the employees. I have to purchase some plant machinery. Again, I have to incur a lot of expenses in that, and all these things. Say they call again. I need some every day for working capital. Some amount. All this is called what you know. This is called sources. If it is about 1 lakh of rupees, with which I have to start a business. This is called, this total requirement is called outlay of the project. What is the total project outlay? About 1 lakh of rupees. This 1 lakh of rupees, how to manage this amount? This is called sources. I need certain sources to have this 1 lakh. Again, after this 1 lakh, supposing I put my own money, say about 20,000. This 20,000 is called the capital. This capital is the my own money is always called capital. And remaining 80 rupees is called outside borrowings. That means capital versus outside borrowings decide the health of a balance sheet. Why you know? Even for the creditors also, supposing they come, business is always a subject linked 90% with the credit. You need to obtain the credit from the market. You need to borrow from the market and do a business because it is not possible for all of us to have entire money put. Okay, there may be such very ideal cases about 10 to 20%, but entire rest of the world, say this 80-90% people, certainly depend upon the borrowings from the outside. Again, in the borrowings, there are two kinds of the borrowings are there. They are called short-term borrowings. Sometimes what will happen? You borrow a person. You borrow from a person, say 1 month, 2 months, 3 months, for a short term, something like hand loan or some adjustments like that. You call that is called a short-term borrowings. You raise. Again, long-term borrowings means supposing you acquire a plant and machinery. Plant and machinery, what will happen normally? Repayment period is 3 4 years. That means I borrow some loan which is repayable beyond a year. Normally, in a convention of the balance sheet or business, all amounts payable within a year are called the short-term borrowings. And again, long-term beyond 1 year, they are called the long-term borrowings. This is the how a balance sheet is classified on the liabilities side. Supposing I get a 5 years of the about 5 lakhs of the loan I have paid, and that means 60 months I have to repay the amount, and say EMI with interest, say about how much it is, about 20,000 or like that. This again EMIs payable within 1 year are called again the short-term borrowings. That means it is a liability you have to pay within a year, and remaining installments you will put a long-term borrowing. Why this classification is required, you will understand, and it has a lot of consequence to the liquidity. Okay, we'll come to the liquidity part also later. What is this liquidity? Again, assets side are concerned, there are the current assets. What is the current asset? Immediately, I need about 100 rupees. And 100 rupees means what does it mean? Then I go to a bank, go to an ATM and withdraw. That means immediately I can get the amount. That immediate is called the liquid asset, current assets. Supposing again there are fixed assets are there. With the loan, you have obtained some small land, small building, small plant and machinery. These are called the fixed assets. They cannot immediately be overnight be what you call sold and realized. They are all called the fixed assets. These fixed assets have certain nature, certain form. So next, after this, what will happen? There are called something called non-current assets. What is the current asset and non-current assets difference means? Supposing current assets or suppose you have to pay within a year some 100 rupees. Okay, and non-current assets means the amount you will realize normally in institutions normally beyond 3 months. Suppose normally current assets are which will come, I have to pay within 3 months. Within 3 to 4 months, all obligations have to pay outside. Supposing I have borrow a credit, I promise him that I will pay within 3 months. That is called a current liability. Against which what will happen? I sold my product to a, some my vendors, my customers, and they assured that they will make a repayment within 3 months. Within 3 months, how to match it? 1 month I have to pay about 100 rupees. Again, 1 month I am getting about 200 rupees of this amount I have sold. Payable 100 rupees is called current liability, and the amount I have to realize from my sales certificate 200, this is called the liquidity. Liquidity is one thing. I must have a comfort to pay my obligations, payment obligations immediately without any kind of discomfort. Somebody asks one month or 2 months, I must have immediate arrangement, a matching current asset to pay. This is called current asset liquidity. As long as this current asset and current what you call current liabilities are in healthy proportion, say 1:2 or like that. 100 I have to pay, 200 I am getting, is extremely comfortable. Supposing 100 I have to pay, but I am having a 50 rupees. Then what will happen? Then you will have a struggle. How to manage the remaining 50 rupees within the this time period of the 2 3 months. This is called the liquidity problem. That means I don't have the liquidity. Again, liquidity has such a consequence. Supposing I am a owner of a very big building, but I don't have 100 rupees to buy one cup of coffee or take some fruit juice or something tiffin. Then what is called, you may have big assets, fixed assets, but I don't have money immediately. Again, this is also kind of the liquidity. That means Fixed assets are more, current assets, liquid assets are less. Again, this is a liquidity issue. Apart from that, what is this non-current asset means? In a short period of time, I have to pay certain amount, but again, I have to realize my amount of, say, for 100 rupees, I have to pay, in old example, 200 rupees I am expecting. But this 200 rupees did not materialize in 3 months' time. What will happen? The person from whom I have to get, they requested time for another 3 4 months. That is called the non-current asset. Yes, I will get the money, but I will get the money, but not in the time. I will get the money, but not in the time to make my payment obligation. That is a non-current asset. It is something like a cow which yields the milk, but suddenly what happens? For a particular period, milk is not coming. There is a gap of 2 3 months is coming. Then what will happen? This is called a liquidity. The deferment, what called postponement, has taken place to get back if what you call that money. Again, it has to be put in order, and again the cow has to leave milk. As expected, it did not give continuously. There is a gap has come, on account of which I could not sell in the market. I could not get the money, and this is called a liquidity issue. And last one is the intangible asset. What is the intangible asset? What is the difference between tangible and intangible assets? Tangible means by the virtue of the meaning, the virtue of the word, that is a called, you can understand, that is visible. Supposing land, building, some furniture, and machinery, they are visible to the eye. They are called tangible assets. What about the intangible assets? Supposing there is a vegetable, there is a brand, there is a called the goodwill in the market. So there is a vegetable vendor is there. He has opened a big shop. What happened? How much he can sell? He can sell, say, about 2 to 3,000 a day. Supposing on the same shop is having the board of some Reliance Small. Then what will happen? The sales will become number of times. Some brand. On account of the brand value, what will happen? The customers have some kind of trust. Customers have trust in the brand. Suppose you go to a particular vendor or a street vendor, there will be doubt in your mind whether it is genuine or not, and with a doubt, and after thorough examination, after thorough evaluation, we take time and try to pick up the cheapest. But in the brand houses, what will happen? Suppose a Tata or something like that, or we are going to brand, and there is no cheating at all. We are assured of the quality and value of the price in the item purchase. This is called the brand. The same quality and also the same quantity I deliver as a new vendor, it will not be pushed in the market at the brand value. This brand value is called the goodwill. Supposing a person, I am having excellent what you call, for example, another one is supposing Reddy's Lab is there. They have developed an R&D product by spending about 100 crores, patented, and it started market. What will happen? They want to sell that. How much they will sell it? Is it that 100 crores they have made it? What you call cost of that development of patent? Will they sell for 100? No. That particular patent is having a potential of yielding 10 times, say 1,000 crores. Correct? What will happen in balance sheet? Actual expenditure 100 crores only, but it is having a potential of 10 times, particular 1,000 crores. Then this extra 7 or 800 crores sale potential today is called a goodwill of the company. Suppose somebody wants to come and buy, he will not sell for 100. So this is a cow. The cost is about 5 lakhs, but it will yield a milk of the 20 lakhs over a period of the time. Like that, what will happen? Accordingly, that value will be fixed about 10 to 12 lakhs more than what he has purchased. Similarly, best example is mango gardens. Mango gardens are purchased 1 year in advance. What will happen? They will count The potential of the yield may be about 100 rupees. In the beginning, he will purchase about, he may invest about 10 rupees. At the end, he will get 100 rupees. So, on the future yield, on the future potential as a market, this is otherwise known as a what you call a brand and a goodwill for the markets. I'm telling you, particularly for the branded market, like even a cloth or something like that, you will immediately go now in a market for a textile market to buy a ready-made pant and shirt. They are carried away by the brand, but the same brand is done by our local tailor, and with a lesser price, we won't buy it. This is called brand. These are the basic what you call classification of balance sheet that is called. One is liabilities, capital, my own money, is otherwise called worth, my worth. And second one is the short term borrowings, say normally for 2 3 months or max of 1 year. Again, a long term borrowings exceeding beyond a year. These are called the classification of the liabilities or debts, what we call. And assets side, again, current assets, immediately the amount I can get anytime I like, I get the amount is called the current. Current means immediate. That assets. Second part is the fixed assets like land, building, plant, machinery. Again, third part is non-current assets. It will get immediately money, but it is delayed. Not than estimated time. I expected 1 month, but it has taken 2 months, 3 months, 4 months like that. Again, it is a non-current asset. Lastly, is called intangible assets like patents, goodwill, something like a trademarks. These are all called they are called the intangible assets. This is how basically a balance sheet is structured. Again, the difference between the liabilities and assets. Liabilities are less, and again, assets are if liabilities are less and assets are more, then it is a positive difference. Then it's called a profit. The difference. And if it is vice versa, if it is otherwise ulta, liabilities are more and assets are less, then it is a loss. This is how a balance sheet is basically structured. From this, and again, and it has a lot of extension of each topic under liabilities, assets, what kind of the what you call consequences are there in financial decisions, and what would be the what call what would contribute health and also prospects of any business and a composition of these assets, how much are liabilities, how much assets, and we will discuss in what you call various phases and stages in the upcoming sessions. This is, and also some of the examples of the balance sheet are also a proprietary balance sheet is there. Again, another one is a partnership balance sheets are there. Again, what you call a corporate balance sheets are there, and each one is guided by certain statutory, that means certain statutory guidelines are there. Again, balance sheets are subject to income tax. Income tax department have requires certain what you call mandatory structured classification. How these balance sheets are viewed and what are the advantages, and how balance sheet is going to help what you call to evaluate health. What will happen at a given point of time? Normally, balance sheets are done 3 months, 6 months, and 9 months and 1 year. Actually, the balance sheet, what we see is a movement. Suppose it's something like a snapshot balance sheet. Actually, it did not reflect. Why I am telling you certain things. Any balance sheet, like a human being, appearing is different. Again, being is different. I may appear extremely sound, wonderful, good, attractive, but inside that particular person may have a serious health complaint, and he may be dullard also. He may not be intelligent also. Similarly, that is called a cover page and content. I am asking. Whereas other Similarly, in balance sheet also, it looks very robust, it looks wonderful, but inside it appears again it is weak, and it may not be as strong as it appears. Therefore, by going to so many intricate details, and we can only evaluate the correct health of the balance sheet. And also, balance sheet under this snapshot of a particular point of the time, say quarterly or half yearly, it only gives what you call a prima facie. That means only on the surface, a superficial position, but we need to go lot of details to determine this strength. And according to and this does the study of the balance sheet is having what you call a scientific approach, and there are several methods, there are several ratios, just like a human being is tested in a diagnostic center, like various parameters like health, bp, kidney functioning, brain functioning, and also liver functioning. So also balance sheet is also having, and the fundamental strength of the balance sheet is whether the balance sheet, whether the business is live or not, it is called the turnover. Because if a turnover is there, so what is a turnover? It is a inhaling and a exhaling, something like a breath. Breathe taking in, breathe taking out. This turnover is again very important. Again, what is now breathe? It has again a scientific parameter like 72 pulses in a minute, like that. Even this turnover formulas are there according to the nature of the industry. This turnover is the most important. It gives the indication that the business is alive, the business is going on. It does not mean just to be like the business is going on, it means it is doing wonders. Again, it has to be diagnosed. Similarly, what you call again the brain means the management, the strength of the management, and overall the heart is the risk factor in the business, or the my own stake and others stake. Supposing I borrowed only, I have only put my money 100 rupees. If I borrowed 1 lakh from outside means my risk is less, and the creditors who have given their money is higher, their risk is more. So actually, health of a balance sheet is known. If a promoter, if a owner is having a more risk and the outside is having a less risk, that is called a ideal balance sheet to start with. So this is called again risk participation, the management. Like that, what again the in a balance sheet, so many evaluation parameters are there, like in human diagnostics and X-ray and functioning blood test, like that. A certain parameters we can evaluate the health, the longevity of a person. So also we can evaluate the future of a what you call a promoter through the balance sheet trading, and it is a vast science. It is a vast science. Over centuries, sorry, over the this science of the business in various forms, from primitive form to today in a very scientific analysis, it has emerged, and it has been taken as a what you call a very valuable R&D research. Documents are also established from the financial analysis and also financial management. And by taking this information as a tool, you can help yourself a lot, not only to work for the growth of your own organization, but also to understand various parameters to face your competitors. The competitors, how others are doing their business, and how you can exceed their parameters, that all will help you to grow strength by strength in the times to come. So this all these aspects in, again once again I am repeating, and several features are there, and discuss topic by topic with the illustrations, and also some of the cases Also case studies also, how balance sheets have been built up over a period of the time, and also how the balance sheet helps to take decisions for the investors also, to put the money for the either as a credit or investment or some or called shareholding participation, who will go in detailed analysis in upcoming sessions. Thank you.